Hi ladies and gentlemen, welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Good day and welcome to this webinar on the IFRS for SMEs, and this webinar particularly deals with section 21 on contingencies and provisions and how to deal with that in terms of the IFRS for SMEs. My name is Anton van Wyk and I'll be presenting this webinar, and on the slide in front of you, you can see my contact details and you're more than welcome to ask any questions or contact me about the content of this particular webinar and using any of those details that I've provided on the slide. Right, so if we move over to the next slide, I thought it was quite important to just open up this discussion on provisions and contingencies. And remember, when we talk about provisions, we're actually talking about nothing other than liabilities. So thinking about liabilities, there are some new developments on the horizon in terms of full IFRS, and I thought it was a good idea to just open up this discussion on liabilities by looking at these. In 2018, the conceptual framework in terms of full IFRS was amended in respect of the definitions of assets and liabilities, the recognition criteria, etc. So if we look at the first amendment there in a bit more detail, the definition of an asset has been rewritten, and also the definition of a liability. And obviously that will impact the way that we look at liabilities. Now it's important to remember that these amendments have been incorporated in full IFRS, and although they haven't amended the IFRS for SMEs as such, it is highly unlikely that the definition of assets and the definition of liabilities will be left untouched in the IFRS for SMEs in respect of these changes that we talk about now. So I think we need to investigate a bit further what these changes are that have been made in terms of these definitions. Secondly, the recognition criteria for elements in the financial statements have also been amended in the conceptual framework in full IFRS. And again, seeing that recognition criteria affect all of the elements in the financial statements, it is highly unlikely that there will be different recognition criteria in terms of the conceptual framework in full IFRS than the ones in the IFRS for SMEs. And that's why I think it's actually quite relevant to look at these developments also from the point of view of the IFRS for SMEs. But I just want to make it clear again, these amendments have not been brought into the IFRS for SMEs as yet, but they may be brought into the IFRS for SMEs at some future point. So this webinar deals with the IFRS for SMEs as it stands in its latest form, and therefore this is not outdated at the date of recording of this webinar. Lastly, additional guidance has also been brought in to the full IFRS conceptual framework in respect of the selection of the correct unit of account, seeing that assets especially are being broken up into different rights. And I think being an accountant, you'll most likely have heard of the changes in respect of lease accounting, where leases are being capitalized onto the statement of financial position of the lessee, regardless of how these leases were classified before. So the whole classification from the lessee's point of view of operating leases and finance leases and all those things, that classification doesn't exist in the full IFRS 16 anymore. So additional guidance is a natural consequence of breaking up this asset into various rights and looking at rights and obligations that exist in terms of these new definitions. So the question that arises then is, do I then separate the rights out of these assets and account for them separately, or do I still account for them as one unit of account? And that is why additional guidance has also been provided in the full IFRS's conceptual framework, that you are enabled to make a clearer selection on the unit of account. So I'm only highlighting these three particular items because I believe they could have an impact on the way that we look at liabilities, also from the point of view of the IFRS for SMEs going forward once the IFRS for SMEs gets updated. So this is basically just a glimpse into the future of the next round of updates that could become applicable to the IFRS for SMEs. If we move on to slide number 4, the new definition for a liability is the following. A liability is still a present obligation, which means that we must be very clear that in whatever we call a liability, we have a present obligation that is undoubted. All right. So present obligation, requires a lot of consideration that goes into that concept, because even for a provision, there must not be any uncertainty, or if there is, we must have taken a view on that uncertainty in respect to the present obligation. So all of us feel that provisions are uncertain elements that we provide for, yes, but only in certain aspects, which we'll talk about later. The one aspect that the uncertainty cannot be left unaddressed for would be the present obligation, because the definition of a provision is that it is a liability, and therefore a liability must have a present obligation in respect of the definition of a liability in terms of the framework. So a liability in terms of full IFRS is still a present obligation of the entity to transfer an economic resource as a result of past events. So the aspect that has been removed from the definition of the liability in full IFRS and in terms of the conceptual framework, therefore, is that section that you see on the slide now, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So this is quite important, ladies and gentlemen, because that expectation of cash outflow or resource outflow in respect of the liability does not appear in the new definition of a liability. Now, this could have certain impacts in the way that we apply the definition of a liability. So it is important to note that the expectation of an outflow of resources has been omitted in the 2018 version of the amended conceptual framework. So again, as we record this webinar, this is still applicable only to full IFRS. But we know that the IFRS for SMEs is due for an update in 2021. And I personally expect that these amendments that we are currently discussing will find themselves into the IFRS for SMEs latest 2021. If we look at the amendments that were made on slide number 5 in respect of the recognition criteria, now these affect all of the elements in the financial statements. So we have 5 elements in financial statements, being assets, liabilities, income, expenses, and equity. Now remember, the recognition process in financial statements is that an element must firstly meet the definition of that element, and then the recognition criteria are being considered. Now, the new amended recognition criteria firstly focus on relevance of the recognition of that particular element. So probability of future economic benefit inflows or outflows, as it was the previous recognition criterion that we considered first, has now been absorbed into the concept of relevance. So if you look on slide 5, relevance incorporates the probability of benefit inflows and outflows in the future, but it is not limited to that. So that whole concept of probable future economic benefit inflows or outflows, depending on whether it's an asset or liability or income or expense, etc. That probability of future economic benefit inflows and outflows is no longer the primary factor that is considered as the first recognition criterion. So you can imagine that when you teach students would like to just test for probability and reliable measurement, because those are the 2 recognition criteria that we actually grew up with, so to speak. So when you talk about recognition criteria, we all think probable future economic benefit inflows and outflows, and an amount or a value that must be reliably measured. All right, and if we can tick those 2 boxes, then automatically we can recognize that element in the financial statements. So this is no longer the case in the new conceptual framework of 2018. The first recognition criterion is relevance, and probability is incorporated in relevance. Now, what is important is that in the conceptual framework, it is very clearly stated that an existence uncertainty is not necessarily automatically blocking recognition like it did in the past.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.